Hey, if you're gearing up for the Certified Financial Management Specialist exam, then you are in exactly the right place. We're about to break down the essentials of capital markets, and my goal is to give you a really solid foundation so you can walk into that test with confidence. Here's our game plan for today. We're going to tackle 4 key areas. First, we'll start with the big picture. What even are stock markets? Then, we'll dive into the two main flavors they come in. After that, we get to the fun part. How do you actually figure out what a company's equity is worth? And we'll wrap it all up by looking at a firm's capital structure. Let's jump in.
At the end of the day, everything we're about to talk about, it all boils down to this one simple but incredibly powerful question: what is a company really worth? Answering that is pretty much the whole point of capital markets. And the quest for that answer, it starts right here. The stock market is the arena, the giant global stage where a company's value is constantly being debated and decided, second by second, through the price of its stock.
So that brings us right to our first section. What are stock markets? You got to get this part down because it's the absolute foundation. Everything else we build today is going to rest right on top of this.
And for anyone going into finance, which I assume is you, this is why this stuff matters so much. The number one job, the primary mission of a financial manager, is to make choices that push that stock price higher. It's the ultimate report card. Okay, so we know why the market is so important. Now let's look at how it actually works. Turns out, it's not just one single thing. You can basically group stock markets into two major categories. One is based on a physical place, and the other is based on a massive digital network. First up, you've got the classic model, the physical stock exchange. I want you to picture the New York Stock Exchange with the trading floor and the bell. These are real, formal organizations in actual buildings. They run as auction markets for stocks that are officially listed to trade there. Now, the complete opposite of that is the over-the-counter market, or OTC. This isn't a place you can visit. It's a huge, decentralized electronic network. Think of it as a giant web connecting thousands of brokers and dealers who are all trading securities that aren't listed on those big formal exchanges. These are often newer or smaller companies. Putting them side by side like this really makes the difference pop. On one hand, physical exchanges have a tangible building and an auction-style market. On the other hand, OTC markets are just a vast electronic network run by thousands of participants in what we call a dealer market. It's really all about location versus network. So how in the world does that dealer market actually work? Well, it pretty much stands on 3 pillars. First, you have the dealers. These folks hold an inventory of stocks and are always ready to buy or sell. They make the market. Second, you've got the brokers, who are like matchmakers, connecting regular investors like us to those dealers. And third, you have the electronic networks, the technology that acts as the glue, linking everyone together. Okay, so we know where stocks get traded, but that just leads to the next logical question, right? How do we figure out what a stock should be worth in the first place? And that, my friends, brings us to equity valuation. Equity valuation sounds complicated, but the idea is simple. It's the process of trying to estimate a firm's true value. But it's all built on one giant core belief, that a stock's value is ultimately driven by how well the actual business is doing. Its sales, its profits, its growth, its fundamentals. Now, for your exam, this slide is absolutely crucial. And here's the secret. It's not about memorizing the 5 names. It's about knowing which tool to pull out of the toolbox for the right job. For instance, if you've got solid forecasts about the future, discounted cash flow is your best friend. But if a bunch of similar companies just got bought, then you're going to lean on precedent transactions. It's all about context. All right, this brings us to the final piece of our puzzle today. We know where stocks trade and we know how to value them. But where does a company get all this money in the first place? That's where we get into a firm's capital structure. So first off, what even is capital? Simply put, it's the money that investors supply to the company. That means things like debt, preferred stock, common stock, and even the earnings the company keeps. Now, here's a super important distinction for your exam. It does not include stuff like accounts payable. That's money a company owes to its suppliers, not cash from investors. A company's capital structure, then, is really just the recipe. It's the percentage mix of these different funding sources. So you can see here, this sample company gets 55% of its funding from debt, 10% from preferred stock, and the last 35% from common equity. So what's the whole point of managing this mix? Well, the goal, the absolute holy grail for a financial manager, is to find the optimal capital structure. And what is that? It's the one specific mix of funding that squeezes out the most possible intrinsic value for the company's stock. And here's the other side of that coin. It's like a two-for-one deal. The exact same structure that maximizes the stock's value also does something else just as important. It minimizes the company's overall cost of getting that money, which we call the weighted average cost of capital, or WACC. They go hand in hand.
All right, let's wrap this up and put a bow on it. Here are the big ideas to lock in for your exam. First, remember markets come in two main types: physical exchanges and electronic OTC networks. Second, equity valuation is all about linking a stock's price back to the health of the business. Third, capital structure is just the company's funding recipe. And finally, the whole point of managing that recipe is to find the optimal mix that maximizes intrinsic value. So I'll leave you with this final thought to chew on. If you think of a company's capital structure as its financial blueprint, how does changing one small part of that blueprint, like, say, adding a bit more debt, affect the final value of the entire building? Understanding that relationship, well, that's the heart of corporate finance right there.